Welcome back to Real Estate Simplified. Cherry, one of the most common questions or concerns people have when they own real estate is capital gains tax. Nobody wants to pay more tax than they have to. So, what can real estate owners do, real estate investors, to minimize their capital gains tax? And maybe before that, what is capital gains in the first place?
Yeah, I think that's an excellent question to start off. So in Canada, when you sell your home, and you purchase a home and you sell it for a profit, there may be some tax implication. If you're selling a home that you do not occupy it and use it as your primary residence, then definitely there's some sort of tax implication. One of the tax implication could be capital gain tax. So for example, if you purchase a home, use it as a long-term rental, buy it for $500,000 and sell it for $600,000 after years of renting out, that $100,000 is considered capital gain. And for capital gain tax to be applied, 50% of the profit would be taxable. And the amount of tax that you would have to pay depends on your personal income.
Yeah. So then what is depreciation then? And how does that affect real estate investors?
Depreciation is some sort of a wear and tear that's recognized by CRA. Essentially what they allow us to do, the Income Tax Act allows the taxpayer who reports rental income to claim the wear and tear on their equipment or the building on its own. Now, capital cost, the proper term for depreciation in the tax term is called capital cost allowance. When you claim capital cost allowance, it's kind of similar to claiming RSP. So the year that you claim the capital cost allowance, the wear and tear on your building, you would be able to defer the net income to a future year to report. But it's only tax deferral. You don't pay tax the year that you claim it. The year that you sell it, you have to bring it all back into income and you pay tax accordingly.
Yeah, so in a nutshell, the government's basically giving you credit because the value of the structure on the land is that will need repair at some point.
Yes, exactly. Yeah.
So then what strategies could real estate investors employ to really minimize the capital gains tax they pay? What sort of things should they be doing during the life or during the time they own the property?
Well, there are a few things. The first thing is tax planning. So to start off, we always ask our clients, for clients who come in to have a consultation with us, we always help them structure in the best possible way. Sometimes the spouse is making a lot less money, and it may be beneficial to have the property registered in the spouse name with proper tax planning. There needs to be an agreement, otherwise the income could be attributed back to the high income earner. So we help our clients to structure it in the most tax advantageous way. That's number one. Number two is that for the expenses that you incur, a lot of them are considered capital improvement to the building, which is also tax deductible against your future capital gain. So make sure you keep all those receipts, and it's important to keep those receipts. Sometimes you hear that, I'm only required to keep receipts for 7 years, but the reality is you might have to keep it for way beyond 7 years. So those are important. Number three is maximize your tax deductions. There are a lot of tax deductions available on your closing documents that you may not even be aware of, and it's not coming in the form of an invoice. Like for example, it would be coming in the form of a mortgage discharge statement, because you get mortgage penalty that you could qualify to write it off against your capital gain. Those documents are also extremely important. And if you already sold your property and you already incur a bunch of capital gain tax and now you're looking for the way to reduce it, the last resort is always RSP contribution.
Yeah, for sure. And just to mention on expenses, there's real estate fees, lawyer fees, title insurance, all of that sort of stuff, which is one of the benefits of owning real estate. It can be very tax advantageous. Now, you mentioned capital expenditures. What's the difference between a capital expenditure, a capital expense, and an operating expense? Because when you're doing your taxes and saving your receipts, that's something somebody should know.
Oh yeah, absolutely. So capital expenditure are upgrades that you do to your property. So what is an upgrade? Upgrade, it could be replacing a regular shingle roof with a metal roof. So it's clearly an upgrade, but replacement means that it is replacing the basic shingle roof with a basic shingle roof that lasts the same duration. And replacement, typically, you can write it off as current expense. upgrade, you have to write it off as capital expenditure. And capital expenditure, the way that it's being claimed, it's being added to the cost of the building. So let's say you purchase a building for $500,000. Now you spend $10,000 upgrading the roof. Now the cost is now $510,000. You can claim capital cost allowance that we earlier mentioned that. You can claim it against your future capital gain, but you cannot claim it as a current expense against your rental income. But because capital gain is considered 50% taxable, and therefore the capital expenditure is only 50% deductible over the long run.
Gotcha. Okay, so switching gears a little bit. Renting out your main home, your primary residence, how does that affect capital gains?
The answer is it depends. It depends on how much of your home is being rented out for, and did you do any structural change to the property as well. And then also it depends on your use of the home, how you use the home. Sometimes some of our clients would use the home for home office expense as well as use the home for rental purpose. So it all comes in together to, we come in to make sure that we do that evaluation to make sure that it actually complies with the primary residence exemption. Now, sometimes if you buy a home that's a fourplex and you live in one of the units, you can only claim that portion of the house as your primary residence. And the 75%, assuming it's 75 and 25, the other 75% of the property, the capital gain that you would make on this property would be taxable.
Gotcha. Okay, so now moving into a rental property. So let's say you own a rental property, now you decide to move into it. Does the situation change?
Yeah, it also makes a difference. If you purchase a rental property, rented it out for a number of years, and then later on decide to move into the property, you may or may not trigger capital gain. So the moment that you move into your rental property, depending on whether you claim capital cost allowance on the building or not, you will trigger, if you do, then you would trigger capital gain the moment that you move in. It kind of sucks. But then if you don't claim capital cost allowance, you would be able to file an election called 45-3 election that would allow you to continue to claim, that would allow you to defer the taxes until you sell it eventually.
Gotcha. And there is a period of time where even if you move out of your primary residence, you still have a grace period, so you're still sheltered from capital gains. Can you elaborate on that?
So there's a couple of things. Like in the example that we mentioned earlier, if you buy a rental property, the example that I always give is that if you live in downtown Toronto, work in downtown Toronto, you don't want to buy in downtown Toronto, your hometown is in Hamilton, and you bought a place in Hamilton and rented it out for a number of years, and then you decide to move back to Hamilton to your own rental house. And during that period of time when you live in Toronto, you don't have your own home, you don't have any primary residence. When you move back to your rental property, you are, provided that you don't claim the capital, you have never claimed the capital cost allowance, you would be able to file the 45-3 election to extend the primary residence exemption for 4 more years. So that helps with that as well.
Oh, it definitely does. Well, coming up after the break, we'll be talking about renovations and taxes. Stay tuned.